Hi everyone, today's video is all about mutual funds and understanding the basics of how they work. My goal is to help everyone be more educated and independent with their money. If that sounds like something you're looking for, hit the subscribe button to let me know you're interested. And let's get started on today's topic. So what exactly is a mutual fund? Well, a mutual fund is an investment vehicle that purchases various investments like stocks and bonds and uses the money that's been pooled by a group of investors. Investors like us would purchase units of a mutual fund and share in the profits of whatever that fund makes. As an example, a very popular type of mutual fund would be a dividend fund. A dividend fund invests in various companies that issue dividends, like banks or telecom companies, for example, and that particular fund could invest in, say, 50 different companies. Owning that fund is so much different than owning 50 individual stocks. Owning stock gives you access to other privileges sometimes, like voting rights, whereas a mutual fund, you don't actually own the stock, nor can you choose to change any investments within the fund that you purchased. This is at the sole discretion of the mutual fund managers. So instead, you're simply benefiting from a portion of the profits that this mutual fund generates, minus any fees that the fund incurs, like administrative fees or management fees. So what does it mean then to actually own a unit in a fund? Well, when you're purchasing stock, for example, a stock price might be $15, $20, $30. In the mutual fund world, we refer to that price as net asset value, or NAV. So as an example, if you had $5,000 to invest today, and the net asset value, or NAV, of the mutual fund was $60, then investing $5,000 would get you 83.33 units of that fund. So you've now invested in a mutual fund and you own some units. So the important question is, how do I make money? Well, there's actually two different ways, either an increase in the NAV or net asset value or income distributions. An increase in NAV is similar to a stock price going up. If you invested $10,000 into a mutual fund that had a NAV of $20, then that would get you 500 units. If that NAV went up to $25 and you sold all 500 units, your $10,000 would now be worth $12,500, and that would leave you with a profit of $2,500, which would be considered a capital gain. Distributions, on the other hand, are when income and capital are paid out to investors, like interest earned on bonds or dividends and capital gains earned on stock that were inside of the mutual fund. It's essentially fund managers passing down profits to the investors. These distributions are usually paid out quarterly, semi-annually, or annually, and they can either be paid to you in cash or they can be automatically reinvested to purchase more units in that fund. So why is someone buying a mutual fund over other types of investments? Well, in my opinion, there's two main reasons. One is convenience, and the second is cheap diversification, at least at the start. From a convenience standpoint, it's the fact that you don't really need to be watching the markets constantly. This is a responsibility of the fund manager who's going to buy and sell investments within the fund on your behalf. And cost and diversification wise, it costs about $10 on average to make a stock purchase. So if you wanted to invest in 50 dividend-paying stocks, then you would need to pay $500 just to get started, and that doesn't include the money that you're going to be investing. And anytime you bought and sold investments within your account, it would cost you $10 each time. This wraps up our video on mutual fund basics. If you found it helpful, let me know by giving the video a thumbs up. If there's another topic you'd like to learn more about, just let me know by commenting below. And don't forget, hit that subscribe button so you keep up to date on weekly video releases. Thanks for watching.